Hello students, I Devtanand Gupta. Today we are going to start a new chapter, that is theory basis of accounting. In this chapter we will discuss topic wise. In first topic I will discuss about the accounting principles, concept and conventions. Okay, before discussing this chapter I want to say something about the basis or fundamental accounting assumptions. Means whatever the financial statements are there, it is prepared on the basis of accounting, profit and loss, trading account, profit and loss, balance sheet and cash flow statement that are prepared from the accounting information are published for the use of different entities, persons, etc. Means whatever the data we are doing, whatever the data we are preparing, whatever the data we are doing or accounting process we are following, we are finding out the profit and loss, gross profit, and it is published in the website. After publishing in the website, the interested persons are going to check the data, whether the business is doing good, bad, this all everything can be checked from there. Therefore, there are three concepts and conventions. We can say that principles, concept and convention. These three terms came. First, let us discuss about the accounting principles. Accounting principles are nothing. It is the basic guideline. Means just like whatever we study in the junior classes, A, B, C, D, E, F, plus, minus, divide, multiplication, and simple interest calculation. These all are the basics of all the subject. Means it does not mean that in which class you study, it is for that class only. It will carry forward to other classes also. These are the basics. That's why in accounting also there are the basic guidelines to be followed for doing accounting practices and procedure. Therefore, these accounting principles are defined in this way. Accounting principles are the basic guideline that provide standard for accounting practices. Here the term came accounting practices and procedures, means whatever the recording to be done, it is to be followed so that uniformity in accounting transaction are maintained. Means whatever the accounting procedures and guideline we are following, it should be same and it should be uniform. It does not mean that this year different accounting procedure I adopt, next year different accounting procedure I am adopting. There will be a confusion. Therefore, accounting principle says that whatever the guideline you are using or the standard you are using, it should be uniform in accounting transaction. That is called accounting principles. Now, next point is about accounting concepts. Accounting concepts are nothing but are the assumption on the basis of which financial statement are prepared. There are certain assumptions, means there are certain assumptions where we have to apply some basis, we have to think that it can be this one also. These all assumptions are said to be the accounting concepts. Then where we are applying this accounting concept, these all are applied in financial statement while preparing trading, profit and loss and balance sheet. Means we are following the accounting principle also, concept also, and next one is known as conventions, accounting convention. What does accounting convention means? These all emerge out of the accounting practices that have been followed by various organizations over a period of time. Means accounting convention are those conventions which we are using, which the organization or various organization or various firm are using for their accounting records over a period of time. Means not only for this year, for next year, means how till the business will continue. These all are said to be the accounting convention. There are the three concepts. First one is accounting principles. Accounting principles means these are the sets of guidelines which provide standards to be followed for maintaining the accounting transaction or maintaining uniformity in accounting transaction. Second one is the accounting concept. Accounting concept, these are the assumptions which are prepared on the basis of financial statements. Now third one concept I discuss about the accounting convention. Accounting conventions I have already discussed. These are the practices where various organizations are following different accounting standard, policies, these and all. That's why it is said accounting convention emerges out of the accounting practices that we followed by the different organization or firm over a period of time. Therefore, we can say that one term it came, that is called GAAP. GAAP means generally accepted accounting principle. Full form of the GAAP, generally accepted accounting principle. Then what does the GAAP mean? GAAP are nothing but it is the concept, accounting concept, convention and principle. This accounting concept, convention and principle what I discussed earlier, this all together is known as GAAP. And there are the certain fundamental accounting assumptions we are going to discuss. First fundamental accounting consumption is consistency concept, next one is going concern concept, consumption, and third one is the accrual assumption. These three assumptions are there which we are going to use. First, let us discuss about the consistency assumption. Consistency assumption means accounting practices once selected and adopted, means any accounting practices we are selecting and adopting, it should be applied consistently year after year. It means that whatever the practices you are choosing, after choosing the practices it cannot be changed year by year, same procedure and same accounting principle to be followed. This will ensure a meaningful study of the performance of the business for a number of years. It means while applying the consistency assumption, what is the merits of this? We can compare year by year, means how we perform last year performance with this current year performance to 5 years before one performance. We can compare everything by keeping the same standard and same principle for recording the transaction in the books of accounts. It also gives meaningful result of each and every transaction. If you keep different accounting principle and you are adopting different standards, then there will be the complexity. We cannot compare the same organization within the same organization last year profit and this year, why it is last year profit is more and why this year profit is lesser more, because accounting standard whatever we applied over there and here it is different. That's why consistency assumption say that whatever the standard you have chosen, it should be applied and adopted year by year. Now second concept or assumption is that going concern assumption. Going concern assumption means whenever the business started, the owner who opened the business, he opened the business for an indefinite period of time. It means that year by year business will run and on its entity. Then this concept assumes that the enterprise has an indefinite life or existence. It can be a number of years. It can be assumed that the intention to liquidate and scale down its operation significantly, means after 10 years, after 15 years, maybe there will be certain problem, this and all, then only it can be business will be liquidate or sold to another persons or group of person. Going concern assumption assumes that anyone is opening business, it will run for an indefinite period of time during its existence. Now third one we are going to discuss is the accrual assumption. Accrual assumption means accrual concept applies equally to the revenue and expenses, means this concept applies where we are doing both revenue and expenses, revenue income generating source, and second one expenses, whatever the expenses we are doing. It applied in both the situation. As per the assumption, revenue and cost are recognized when they are earned, means when we are earning, when we earn that income, then it is said to be incurred, not at the time when the settlement is done. Or simply we can say that revenue and the cost are recognized when they are earned or incurred, means you are going to do or you are thinking to do this one, that time no need to do that procedure and all, means one time when one settlement is done, that time only we can assume that accrual concept is following. Now let us discuss about the accounting principles. Accounting principle, I have already discussed. These are the guidelines given, guidelines that provide standards to be followed for maintaining accounting transaction in a uniformity manner. Now we are going to discuss about the different principles that has been applied in the accounting. First one, we are going to discuss about the business entity concept. Business entity concept or assumption, a business should be understood as a separate entity apart from its owner or businessman, means business and business owner, businessman or business, it should be totally different. It cannot be mixed up, means whatever the transaction he is doing within the business, within its home or personal home, it should not be mixed up with the business one. That's why business has different entity and owner has its different entity. Transaction of the business should be merged. It should not be merged with the personal transaction of the businessman, means whatever the personal transaction of the businessman are there, it should be kept separately. It should not be merged with the businesses and all. For example, when the owner invests money into the business, the accountant should consider the following. The business received cash in the cash book. First, whenever the business is started, owner whatever they invested, accountant should keep in things in mind. There are two things. One is the cash, the businessman received cash in the cash book. Second one is the business owes the amount to the owner, means second, from the business point of view, it is the liability of the business to pay back his capital with profit and all. Now number 2, we are going to discuss about money measurement concept. Money measurement principle or concept, we can say that whatever the transaction is going to be recorded in the books of account, it should be in monetary term. Suppose I purchase 240 machines at the rate of 1000, then this will be not be recorded in the books, it should be recorded in monetary term. That one it will be 2,40,000. This 2,40,000 that is expressed in term of money is recorded in the book of accounts, not units and its unit price. Therefore, a business deals in various items with different sizes, shapes and units of measurement for the purpose of accounting that relevant factors of measurement in money as a measure, such as office building worth rupees 5,50,000, factory building worth rupees 6 lakh, 2,40,000 is meaningful information from the accounting point of view, not in counting, but it should be in monetary term. Therefore, money measurement principle says that whatever the business transaction has been done, it should be done in monetary terms and it should be measured in money only. Now let us go to the we can say that I am happy. Happiness cannot be measured in terms of money, that's why it should not be recorded in the books of account. This concept or principle said that whatever it should be in terms of money as a measurement tool. Now let us go to the number 3, that is accounting period principle. Accounting period principle, as per the going concern, Assumption the life of the business is indefinite, means we cannot say I will continue the business for 5 years, 6 years, 7 years or 10 years or 20 years. It can be 1 year also, it can be 2 years also, but anyone is opening businesses and all, they think that business will continue for a long period of time. Now to assess the performance of the business, it is illogical to wait for the life of the business to come an end. To calculate the profit and loss, to overcome the problem for the purpose of calculation of profits, losses from year to year or segment wise, it can be done. Therefore, to calculate, there are four segments are there. First one, measure the progress of the business accurately, means whatever the business progress are there, it should be measured properly. Number B, business facilitates comparison, means whatever the period are there, we can comparison from one period to another period. Now number C, match periodic revenue with the expenses for getting correct business result, means measure the progress of business accurately. Next one is facility comparison. Third one is the match period revenue with expenses, means revenue is there, then for earning the revenue we have done certain types of expenses, these all also to be measured. Now third, to calculate income tax and other government dues. In India, we practice two type of accounting period, that is, one is calendar year, that is from January to December, which is normally used, and next one is known as accounting year. Accounting year is start from 1st April and it ends to 31st March. These are the two periods of accounting. We can follow any one, but measure is the 1st April to 31st March is the important one. Therefore, we can say that one is calendar year and one is fiscal year or financial year, that is 1st April to 31st March. Between these two, second one, accounting period, is used by the different organization, and mostly it is used in organization, financial year and all. Now let us go to the point number 4. In point number 4, principle of full disclosure. Principle of full disclosure implies that the accounting report should be full and accurate, means there will be no misleading information, it should be full information should be provided and in accurate form. If there is any material fact which can affect the profitability of the business in future, it must disclose to the user, means user should know all the information whether it is legally required or not. Therefore, we can say that there are the standard forms of balance sheet, notes to accounts for the balance sheet and the profit and loss we should measure. It is a legal requirement for the joint stock companies to represent or present information in standardized form, means whatever the principles are there, principle of full disclosure said, means details or information should not be hidden, whether it should be legally or not, everything should be provided properly in accurate form. Now let us go to the materiality principle. Materiality principle says this is a reception of the full disclosure principle. Financial statements should disclose all items that are material enough to influence decision making, means whatever the information are there, it is just extension of principle of full disclosure, means whatever the material is required which it can affect the profit, which it can recognize to influence the decision making, items are accounted on the basis of significance rather than accurate adherence to principle. We do classify expenses into revenue and capital expenses on the basis of principle. Purchase of pencil is treated as an expense, not as an asset, but purchase of a machine is treated purchase of asset, not an expense, means here materiality principle says that whether we are purchasing assets or expenses, it should be identified in a proper way. It does not mean when we are purchasing a pencil, it means we are doing our expenses. When we are purchasing a building for furniture, this and all, it is an asset for us, because we have already discussed in chapter 2, means long term asset are those assets which are used for a longer period of time. But pencil cannot be used for a longer period of time. It has definitely lifetime. After using pencil for 1 month or 20 days or 30 days, pencil will be finished, or it will become too much small that you are unable to use it. But machines, furniture are that type of asset which can be used for a longer period of time. That's why they are said to be assets. Now next one, we are going to the Prudence Principle. Prudence Principle, or it is also known as conservatism. Conservatism. In this principle requires a business to be extremely cautious about possible losses. Means anyone is doing business, it does not mean that business is always running profit, but sometime it will get loss also. Therefore we can say that there need not to be any provision for anticipated revenue or gains. Provision for bad debt is to be created on the basis of requirement. When a business say that they have a debtors, our experience remind out there will be a loss also. Debtor means whenever we are selling a goods and credit, out of 10 debtors, one customer will be that type that he will not pay the money, or these are the future losses of the business. We reduce bad debt from debtors to present a conservative estimate or realizable value of the, means conservative object means suppose out of 10,000 debtors, one debtor is having 1,000, he is unable to pay, then 9,000 will be recorded, will be shown, and this 1,000 will be treated as bad debt. Now let us go to the historical concept. Historical cost means assets, all fixed assets should be recorded in the books of account in historical cost. Historical cost is the cost which an asset originally purchased, means whatever the purchase price of the assets is there, that should be shown in the books of account as per the historical cost concept, not the present value or market value will show in the cost of purchase. Now let us go to the next concept. Next concept is dual aspect principle. Dual aspect principle means it says there are two aspects are there. One is assets is always equals to liabilities plus capital. It has two aspects. One side is asset and one side is liabilities plus capital. In each and every transaction, these two aspects will be there only. Now let us go to the, or we can say that in dual aspect principle there are two aspects are there. One is debit aspect and one is credit aspect. Now let us go to the next concept, that is revenue recognition principle. Revenue recognition principle suggests that revenue should be recognized as realized when earning process is reasonably complete. Means suppose someone give an order, that is not a revenue. When someone gave an order, then order is delivered and money is realized, that is called revenue recognized principle. The amount is capable of objective measurement. Merely getting an order from the customer from a customer is not regarded as a sales. When you are delivering the goods to the customer, that is a sales. Now revenue from sales should be recognized during the period of sales occur. Means whatever the revenue I earned, it should be recognized when the sales process has been conducted or completed. Now next let us go to the last concept, that is called matching principle of revenue and expenses. Matching principle of revenue and expenses says that in one business there should be a revenue also and there should be a expenses also. It means that matching principle suggests that we must match the revenue at a particular period with expenses of that particular period only to get a correct period. Means whatever the matching principle says that whatever the revenue and expenses has been done, it should be measured in one period only. It means if you are using calendar year January to December, then you are able to calculate or present that revenue and expenses within that calendar year, or accounting year you are using, then 1st April to 31st March, within this year only you will recognize revenue and expenses to get a clear profit or because business has the intention of making profit. Profit is the excess of revenue over expenditure. Means whenever the revenue we are getting, it means whatever the business are there, their motive is to earn a profit. How they will earn the profit? By generating the revenue, but there will be the expenditure also. After deducting expenditure from revenue, we are getting profit. Now let us take an example. To ascertain the profit for a period, the business must identify a revenue for a period and compare it with the related expenses to earn that revenue. Means whatever the business we are doing, when business is carried out, revenue will be there, but related to revenue there will be some sort of expenses and all also. That's why we can say that matching the principle of revenue, it should be done in one accounting period and all. Okay, thank you.